So we talked about how you can put money into a bank and how money is worth more today than it is tomorrow because you can put money in the bank and earn interest on it. So let's talk about interest rate dynamics. So what is an interest rate? It's the cost of borrowing or the cost that one pays for the rental or borrowing of funds. It impacts mortgages, student loans, credit cards, and savings. If you had any of these, there's a good chance you're very familiar with interest rates, and hopefully you haven't paid tons of interest, but interest can start adding up. And if you're more interested on if you're thinking about how to save it, you can take my personal finance class. So interest rates. The money lender takes a risk, and that's usually the bank, that the borrower may not pay back the loan, which is generally you borrowing money, let's say, to buy a house. Thus, interest provides a certain compensation for bearing that risk. Coupled with the risk of default is the risk of inflation. So when you lend money now, the prices of goods and services may go up by the time you are paid back. So your money's original purchasing power would decrease. Thus, interest protects against future rises in inflation. A lender, such as a bank, which is pictured here, uses the interest to process account costs as well. Borrowers, so someone like you, pay interest because they must pay a price for gaining the ability to spend right now instead of having to wait years to save up enough money. So for example, a person or family may take out a mortgage for a house, which is pictured here, a loan for which they cannot presently pay in full, but the loan allows them to become homeowners, quote unquote, now instead of far into the future. So also I want to point out that just because you bought the home, if most of it's paid by a mortgage, you do not actually own the home. So that's why I say quote unquote on homeowners, because the bank actually owns that loan. And that's what we talk about during my personal finance class. Businesses also borrow for future profit. So if I'm a business, I may borrow to buy equipment now so that I can begin earning revenues today. Interest can thus be considered a cost for one entity, so a cost for us if we're borrowing to buy a house, and income for another, so the bank is earning money. Interest is the opportunity cost of keeping your money as cash under your mattress as opposed to lending. So let's talk about the supply and demand. Interest rates levels are a factor of supply and demand of credit. An increase in the demand for credit will raise interest rates, while a decrease in the demand for credit will decrease them. Conversely, an increase in the supply of credit will reduce interest rates, so like credit is readily available, while a decrease in the supply of credit will increase them. The supply of credit is increased by an increased amount of money made available to borrowers. So if there's just a lot of money floating around and I can borrow a lot more money, then that's an increased supply. For example, when you open a bank account, you're actually lending money to the bank. Depending on the kind of account you open, the bank can use that money for providing other loans and investment activities. Credit available to the economy is decreased as lenders decide to defer the repayment of their loans. For instance, when you decide to postpone paying this month's credit card bill until next month or even later, you're not only increasing the amount of interest you will have to pay, but also decreasing the amount of credit available in the market. So the bank's providing it to other loans and investment activities. So when that's part of the supply, the demand is the other loans and investment activity that people are borrowing from the bank. So when you don't pay off your credit card, for example, this in turn will increase the interest rates in the economy because it's lowering the supply of money. So now let's talk about the components of interest rates.